Diversified engineering company UGL failed to please the market today despite lifting profit by 10% for another record result. Investors had been hoping for more, and the company hasn't offered any specific guidance on future earnings, saying it needs to assess global economic situations first. Here's Simon Palin.
Engineering company UGL has notched up its 10th consecutive year of profit growth. The company's CEO says the earnings reliability comes down to tight risk management.
We've tried not to take risks that we couldn't contain. I think the last year or two or three even have seen many of our contractor competitors have stumbled on risk management.
We also saw the company reduce debt by 23%, which was also a very good step, particularly in these uncertain times.
Another of UGL's strengths is its diversified portfolio across rail, resources, real estate and services. For the year to June, it posted a net profit after tax of more than $158 million. That's up 9.7% on the year before. On paper, it all looks healthy, but the result didn't please everyone.
Analysts were expecting something around the vicinity of 10 to 12%. The company had provided guidance of 10 to 15.
Even with a record dividend of 70 cents per share, UGL's shares slipped almost 2% today. Investors were also wary, with the company failing, for the moment at least, to offer any specific guidance for the period ahead.
The US in the last week or so, week or two or three, has seen dramatic change in the macroeconomic environment. It could have an effect on our US business. We want to have a look at that. We don't know that it has yet, and so far it hasn't, but it could. And before we firm up the guidance for 2012, we want to have a look at that.
All of UGL's 4 divisions recorded profit growth, but its resources division was held back by 2 problem contracts in the first half.
That was the Pluto project, where we had some productivity issues and we didn't contribute our margin from that contract. And secondly, on some work we did for BHP that didn't perform as well as should have and had lower margins.
It continues to be quite a tough time with regards to the large engineering firms. It's been well publicised. Other companies such as Leighton, for example, have experienced similar sorts of issues. With regards to tightening margins, it's becoming increasingly difficult for those large-scale projects to come on board to companies like UGL in an increasingly competitive environment.
And Richard Lupin says that greater competition is not just coming from local rivals, but more particularly from offshore.